Welcome to this issue of the Audit Opinion. I'm joined here today by somebody I've been looking forward to interviewing for some time, Dan Hood. Dan, would you mind introducing yourself to the audience?
Sure. I'm Dan Hood. I'm the editor-in-chief of Accounting Today. We're sort of the publication of record for the public accounting profession, primarily in the United States. I've been here for at some point I recently counted how many years I've been here. It's almost 30 years, which is a long time. That's all I'm going to say about that.
Almost 30 years reporting on the profession, the trends. I'm looking forward to digging into what you're seeing currently, some of the things that you've been working on, some of the data you've got access to, Dan, that only you can provide this perspective. Private equity's involvement in the accounting profession has been something that you've covered quite extensively over the last number of years. I mean, you even have a conference that you've specifically put on to be able to try and educate people on the pros and cons and just generally everything that's involved in this.
Right.
Dialing up to a high level, what are you seeing as being the big macro impact on the accounting profession of this high level of interest from private equity investors in accounting?
Couple of things. I mean, sure, first and foremost, I think for a lot of firms, is it's raised the prices for accounting firms enormously. Even if you're not in any way involved with PE, we've talked to firms that are, just to have a strategy based around acquisitions, and they're saying it's really difficult for them because private equity just comes in with a ton of money and sort of raises fraud, and raises expectations on the parts of firms. They're like, well, everyone's getting $1 gazillion, or a multiple of 9 or 10 or 11 or 16. Multiple used to be one for a long time. The essential multiple for that you base accounting firm deals on was one. And now they're talking, like I said, 9, 10 crazy ones that go up to, I've heard, as high as 16. But what that means is a couple of things. A lot of accounting firm mergers also, there was no cash. It was just, yeah, you come on and become a partner and you become part of our partnership. Not always, but that was a standard model. So we're seeing a lot more cash and a lot higher prices. So that's changing the M&A landscape, which is becoming more and more important, particularly as we talked about, there's a lot of baby boomers in the leadership of accounting firms. They're looking to retire. A lot of baby boomer owners are looking to retire. So pricing going up, that's sort of one big change that we're seeing. The other change that's sort of broader is I think people are thinking much more differently about what an accounting firm looks like, what an accounting firm can be. And I think this was driven by M&A, or driven by PE, but I think it's going to become much more important as other players from outside the profession look at PE and accounting and go, hey, if they could do that, we could do that. We can come in and offer this. Or people say, look in the profession and say, well, people don't want to go with PE. What's an alternative model we can offer them? We may not want to buy accounting firms ourselves, but we can help them stay independent if we want. So you get things like ESOPs, right? We're seeing more interest in ESOPs over the last couple of years than in the previous 25 combined. There were always a couple of accounting firms that had been ESOPs for decades, but that was not a thing that a lot of firms said, oh yeah, we can do that. Now suddenly firms all over the place are thinking, or talking to ESOP brokers or ESOP educators or ESOP consultants. Similarly, you're seeing, more and more people come in and say, listen, if you just need capital, if you're going with PE because you want capital to fuel M&A or to fuel technology acquisitions, which is, that's as a side note, we do a survey about why you're looking about PEs that we unveiled at our conference last year. And we asked, why are you taking PE money? And there was a lot of expectations around it. And the number one answer was for technology spending, which was, we all found sort of surprising. We thought it was going to be for partner buyouts. We thought it was going to be for M&A strategies. And those were definitely highly cited reasons. But the number one was technology investments. It was sort of goes to what we were talking earlier about expectations around what is AI going to cost us? And what is new technology going to cost us? Anyways, it's a little bit of a tangent there, but we're seeing, other providers of capital come in and say, listen, if you just need money, everyone knows accountants are a safe bet. Everyone knows you can lend to accountants. That's not a problem. No one's going to worry about them as a credit risk. But then you're also seeing other people come in from outside family offices, got a lot of money, need to invest it, looking for safe places to put it. Accounting firm is a great investment because then you also can get the services of the accounting firm, right? We're seeing wealth management firms or RIAs pick up accounting firms. They've got money. They've got clients who can definitely benefit from those services. They expand what the wealth manager or the RIA can offer. So there's all these kinds of players looking at the accounting profession with interest, and people within the profession saying, well, we can be different. We don't have to just be an accounting firm. Not that there's anything wrong with being an accounting firm, but say our solutions aren't just we can merge with another accounting firm. That PE came along and they said, well, you can, be acquired by PE, which comes with its own set of expectations. Now you can also become an ESOP. Or you can, if you need to fuel a strategy, there's other ways to get money for it. Or you can be acquired and become an in-house arm of like I said, a family office. I think we're going to see. I say this, but I've really just I'm parroting predictions made by people who are deep into this area of accounting firm transition and succession. The expectation that we'll see a couple of IPOs in the next year or two from accounting firms. There's already one public accounting firm, but uh, they're probably going to see a couple more. Yeah, maybe they'll be big four, but maybe they'll be smaller. Who knows? I think we're also going to see people talk about seeing sovereign wealth funds come in or pension funds. Right? What's better for a pension fund than a steady producer like accounting? In good times and bad, they're always turning over cash. So I think that's a big change that accounting. I don't think it was PE's intention, but it has definitely opened up a field of possibilities for accounting firms in terms of structure, in terms of ownership, in terms of capital sources that they've never had before. It's confusing and it requires a lot of research for firms to sort of figure it out. But it's and that's one of the reasons we put on the conference. But it is, I think it's really exciting. The question is, how long does it last? Does everybody follow a different path? And accounting firms can have a million different forms, and that's the way it is forever. Or do we have 5 years where we experiment and then everyone comes back to being the same old model? I don't know. We'll see. But because we've done that before, we did it in the late '90s. There was this huge explosion of different ways you could be an accounting firm and all kinds of consolidators coming in, waves of acquisition and stuff like that. And an explosion. That's when the alternative practice structure was invented and so on. And it was this huge explosion of different opportunities. And within 5 years, it had all gone back to, yeah, this is what an accounting firm looks like. There's only one method, and there were all kinds of perfectly good reasons for that. So it'll be interesting to see what happens this time. If we expand and stay, or if we try a bunch of things and say, no, we'll go back to the original.
And we've seen a number of firms in the US and the UK, and now it's starting to branch out even further, go down this route of taking on private equity and investment. But the reality is that most accounting firms remain independent partnerships.
Right.
Now, those firms, I'm hearing, and I'm sure you are as well, are having the door banged down in terms of private equity investors wanting to speak to them, wanting to lay out, this is what the proposition looks like. This is why you should be thinking about this. For those firms who are cautious about those conversations, what are you recommending to them, Dan, as the things that they should really be trying to probe and understand to work out whether this is something that they might want to explore further?
Right. I think the first thing is to understand themselves. This is a little bit of annoying Socratic wisdom, right? Is you need to understand what you want. I don't think there is a lot as there is in every profession, but there is a lot in the accounting profession of, well, this is just what an accounting firm is, and this is just how we do it, and this is just the way it is. And there's not a lot of self-examination to say, well, why are we doing it this way, and why do we want to be structured this way? And why are we a partnership? Is it good? Does it help us? And in many cases, it does if it's a well-run thing. And in many cases, it's just a partnership because that's what accounting firms do. So I think the first thing is to sort of say, why are you a firm? What do you want from a firm? What do your partners want? How old are they? How many young people do you have coming up who might succeed you? Are you looking to grow in a big way? Is serious entrepreneurship and expansion big for you? Are you looking to be more of a lifestyle firm where it's just like we all make like great livings? But we don't need to become, a national behemoth who, rivaling the big four kind of thing. And all those are perfectly reasonable goals, but you got to know what your goals are, right? And I think that's probably the first thing, which is annoying for a lot of people to hear. The first thing is you got to decide what you want, who you are and what you want. And this is important, I would say, as you're doing that, talk to everybody in your firm, or maybe not everybody, but certainly your leadership group and your upcoming leadership group if you have one. If you don't, that probably answers some of your questions already. But get a sense of what everybody wants. So the people who really want to be, partners, because that's a big role. It requires a lot of effort. The reward is tremendous. But some people might say, actually, I'm more comfortable in a more corporate thing where I get a salary and I come in every day, and I get the little extra bonus of having some ownership in the firm, but not the responsibility of being the partner. So that's we start with that. I think then just the understanding PE, there are opportunities and pros and cons that go with PE. The first thing to do is start talking to other accounting firms. You do lose control. You will find yourself reporting and responsible to people who are not accountants and people who may. I don't want to say that accounting firm leadership is easy on other accountants, but I think you'll find that the average partner group is easier on its partner group and on its staff than a PE ownership. Maybe they're going to require more. They're going to expect more in terms of results. When you say we're going to do this next quarter, they're going to expect you to do that next quarter in a way that's much more serious than a current partner group. There is just an element of the partnership that it makes it very difficult for people who are equal owners to hold each other accountable. So I think you have to understand that those things may come along, and it may mean giving up some control and answering to a new set of masters. And if you're comfortable with that, then you also have to look at, well, what if you don't? What do you have to do to remain independent? I think this is one that a lot of firms who declared that they intend on being independent haven't necessarily thought all the way through. What does it mean to be independent? You can't just keep being an accounting firm because your competitors are working with PE, and your PE firms are looking to expand all around you, and they're changing. Like I said, they're changing the landscape in so many ways. There's not just the prices of firms that are changing. Staffing salaries, salaries are changing because private equity is ready to say, "Listen, you need staff. We're going to invest." They have money, so that's going to change salary levels. The investments they're able to make, et cetera, et cetera. So you have to be thinking about what are you going to do to stay competitive in a world where your competitors have a lot more money and a lot more resources to move forward. Then just look at the 3 or 4 options I outlined earlier and understand which of them makes sense to you. If there are all kinds of complex financial structures that go along with an ESOP, for instance, they're very cool. But if you've got a staff that is mostly transient, if you're turning over your staff every 2 or 3 years because they're moving on to new opportunities, an ESOP may not be the right move for you, right? Or if you may help you stop that turnover, but you also got to look and say at your staffers, like, are we mostly a place that young people come and work at for a couple of years and get a good grounding and then move on? That's a perfectly good model if it works for you. But then you want to say, well, probably an ESOP is not going to deliver much value, et cetera, et cetera. You just got to be thinking about what do those opportunities mean. And I think it's just there's an education requirement for a lot of firms to think more about what their firm looks like, what they want from it, and what those different opportunities mean for them.
I like what you're sharing there, Dan, because I think it's about making a very intentional decision here. But there isn't an option to make no decision. There isn't an option to
Exactly.
just
Yeah.
keep doing what you have been doing previously. If you are choosing to remain independent, then great. But that also comes with a decision, which is okay. So we are now going to have to invest in technology. We're going to have to invest in people because if we don't, then the competitors who are taking on investment are investing heavily in technology. They are investing heavily in this, broader leadership team structure, et cetera, et cetera, et cetera. And so remaining independent is a decision that also comes with a number of things that require you to make investments in transforming your firm yourself rather than necessarily a private equity investment coming in. I'm not going to say pros and cons of both of those approaches, but what I don't want to see is firms remaining independent on if we just make no decision, we can just continue as we are.
Right. Yeah. No, that's an excellent point. There is no option to make no decision. Everything is a decision, and everything comes with an extra set of responsibilities. Right. Like I said, if you stay independent, that's fine, but it comes with some extra things you need to figure out. I think we should just throw this out. I always like to mention it. If you're a Main Street CPA, or I guess a high street CPA, if you're just yourself and a couple of staff and you're doing tax returns or just basic business booking and stuff like that, you probably can make no decision and just keep going, right? There's vast majority of the accounting profession is very small firms. We're really talking about once you start to get larger, once you start to get, 4, 5, 6, 10 partners, once you're making a certain amount of revenue, 5 million or more, that kind of thing. That's where you really, that's what we're really talking about here. Just to make clear, because I always think, I feel bad for guys who are like, I just do tax returns. Why do I need to worry about private equity? They probably don't, to be fair. It's when you get to be more of a larger firm. And there you absolutely, as you say, you have to make decisions and take on some extra work.
One of the things that naturally comes with private equity investment is a shorter term time frame because, as most people will be aware, private equity firms are typically looking to get a return on that investment in 3 to 7 years through predominantly an exit. So that shifts because most accounting firms have been typically running their business on a long-term view, partnership. We're cycling partners out, we're cycling new partners in, but we're not really thinking about where are we going to be in the next 2 to 3 years because we've got to hit a number. So how are you starting to see that maybe more short-term, more targets-orientated accountability impacting how some of the firms are being run here?
It's exactly that. I mean, it's there. This was things the firms wanted to do, or firm leadership wanted to do for a long time. Anyways, they wanted to get their partners more accountable. They want to be able to set numbers and expect to be able to hit them, whatever those numbers are, whether it's hiring or revenue or new pipeline of new prospects, et cetera, et cetera. Um, the things that, progressive leadership wanted to do for a long time anyways. And so I think it's for some of those firms, they're like, this is great. We have outsiders that we can blame, that we're pushing hard on this. But I think that we're starting to see that at some firms, but the firms that have taken PE knew that was coming. I think that they knew, they understood what it would be to take on a PE partner. That would mean some more reporting, mean some more responsibility. I think we're going to find as more firms go with more PE firms, that we're going to find that maybe a bit of a shock to some of the sort of second generation accounting firms. And I don't mean literally second generation, but the second generation of PE partnering accounting firms may find that a little bit of a shock. That suddenly like, oh, you mean I have to fulfill this quarterly plan? That's not what I was thinking about. As you say, my plan was based on here to my retirement. That is my time frame. As they start to pick up a shorter time frame, I think we're going to see. Um, some shock and a little bit of dismay among accounting firms. I also wonder, accounting firms do generally grow pretty well. So I'm curious to see how much of a problem that will be for PE firms. Like, are they going to suddenly discover, wow, they're not going to discover, let's put it this way. They're probably not going to discover that, wow, this investment is not really working out. Um, how do we tighten the screws, right? Accounting firms are going to do well. There's a tremendous amount of opportunity for them. There are, I don't want to say easy ways, but there are lots of ways for accounting firms to make money that don't require drastic measures. Um, so I think we're going to see a mix of sort of shock and dismay from some firms. This is like, well, I was not planning on this at all. This level of accountability or this level of management severity. But on the other hand, I think we're not going to find that PE firms are going to be, you know, pushing and growling, going, "Here, this is terrible. We got to strip assets and fire people and do whatever." Some mix in between is probably what we'll see as PE firms get a little closer to their turns. I think that's the real thing we're all waiting for, is to see a really serious, like, clear turn. There was one accounting firm that was sold from Citrus Group, and it was, from one PE firm to another one. Um, I think as we see more, and we'll probably see maybe some this year, or maybe the year after, we'll see a lot more of those and get a sense of what that looks like. Because some of it will be, how worried are PE firms about being able to make their flip? If they're super worried about it, then they're going to start coming in and cracking the whip a lot more than they might if they're like, yeah, people want to buy this. I'm in good shape. So I think a lot of that depends on the results of those first flips. So we got to hope they go well. So otherwise, like I said, cracking the whip.
What are you seeing as being some of the key trends, things that are happening as firms really think differently about capacity, about the way they go about building their firm for the next 3 to 5 years, Dan?
Right. I would say one thing, just quick thing, is that we are seeing uh, a willingness to pay more, which is some of that I mentioned described as being driven by PE. It's not driven entirely by PE. It's just driven by the lack of, how hard it has been to fill spots. We're finally seeing accounting firms starting to raise salaries in a meaningful way, which is great, because they were underpaying their particularly their entry level staff for a long time. But more to the sort of long term point is, I think we're seeing them think differently about their teams. One of the ways, just as an example of that, is we're seeing firms move away from thinking that the people who work at our firm are accountants. They're looking beyond just people who've had accounting degrees, people who graduated from accounting, people who've become CPAs or gotten credentials in accounting. They're looking at all kinds of other experts as they move more, particularly more towards advisory services that require other people, that require more data analysts, that require more experts in particular fields. You're seeing, particularly at larger firms, they'll be talking about, if you're going to go into ESG, for instance, ESG reporting is going to be a tremendous opportunity. It's going to be a little delayed in the United States, but it's already big in lots of other parts of the world, and it's only going to grow here. Like I said, just be a little delayed. So you'll get that, and you say, well, okay, then I may need environmental engineers. I may need other kinds of engineers. I may need sociologists. I may need, and for any service you're offering, whether it's audit or whether it's a consultancy around that or anything, you're going to need all these extra sets of expertise. And I think accounting firms are starting to say, yeah, that makes sense. We can do that. We can have teams that are not predominantly accountants. And I still think we're going to see a lot more firms, particularly larger ones, where the percentage of CPAs or credentialed accountants in their workforce declines. And they may still keep it to, partner numbers may be mostly still credentialed accountants. But even there, we're seeing an openness for firms to, make their marketing directors partners, or making their IT directors partners, or making the heads of particular service lines who aren't accountants. Maybe they were police officers, former FBI officers who went to start a forensic accounting unit at an accounting firm, but they're not a CPA. There's been an openness to making them partners. So I think we're going to see, particularly at larger firms, like I said, we're going to see that shift away from a CPA heavy uh, 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 workforce to a more CPA directed workforce. Maybe that's one way to put it. I think they expect to still be in charge, but they expect to, work with a much broader group of people. I think, similarly, as part of that, we're going to see more firms be interested in building up the skills of their younger staff earlier. One of the things accounting firms have sort of relied on to train staff has been, well, you're going to do 2 or 3 years of grunt work, and that's going to get you into the guts of whatever area you're in, whether it's tax. Looking at 10,000 tax returns is a great way to learn. Well, this is a great way. It is a way to learn how to do tax returns, and you're in the guts there. You're learning it. The same thing with any other service, right? You do a lot of that grunt work, and you're running the numbers literally sort of through your fingers, and so that is a way to learn. It's not necessarily the most efficient or fastest way or the most fun way. I think we're going to see shifts in that where firms try to figure out, because they're automating a lot of their work, I don't need to pay somebody a higher salary because I've got to pay higher salaries for entry level people. So do I really want to have them doing that grunt work? And I don't need them to do it, but I still need them to learn. So they're going to be finding ways to train them in the higher level stuff that normally they would just sort of get by osmosis. They're going to find ways to train. And I think they're going to pay more attention to that, to building up their skill sets as they earlier as they grow.
It's an exciting time. Dan,
Yeah,
I've really
very
enjoyed
exciting.
the conversation.
Yeah,
Thank you
great
very
stuff.
much
Thank
for
you.
today.
A pleasure.